We are simply so much interested in doing long-term investments. We think that after 10 years or 20 years or after 30 years we are going to get a great amount of money, and that time we shall have become happy. But there are some don'ts also about this fact. After a very long period of time, your age will also have increased, and that craze what you are feeling right now will not be the same at that period of the time. It can be good, of course, for youths aged around 20 years, because after 20 years around, when they will have come to their 40s, then they will get an amount, and definitely they can make a use of it. And it is good for children also, because when they will have become youths, then that amount of money what they will get after the completion of the time period of the investment, then they can use that money. But there is a little problem too. Remember some facts also. See, when your children and also you get a big amount of money, then what do you think you are really going to use it perfectly? In most of the cases, misuse of the money is found to be taking place. And it brings laziness also in the children. When your children will get that amount, or through you also, when they will get that richness, they will come to a point that they do not have to earn much now, because they already have such a great amount of money, and now they can just enjoy. And in this way, laziness definitely takes place in their life. And money can never buy happiness. This is a very common fact. Money buys opportunities, no doubt, but it never buys happiness. And this is now dependent on you, whether how you use those opportunities in your life. If you misuse those opportunities, then definitely you are not going to get that ultimate goal which is really there in our life. So we have to be careful about such facts also. Happiness is actually our nature by birth. It does not have to be purchased anywhere. Money is a medium for purchasing things, not emotions. Emotions are maintained or fulfilled or flourished only by love. And remember, love is never dependent on money. But still remember the fact that I do not want to say you should not do investments. Definitely you should do investments. But remember a thing, that you should be focused on your present time, not on the future. Long-term investment breaks your nature into 2 points, present and future. And when your emotion or your attention is broken into 2 points, then definitely you are not focused on your present time. And this way, your happiness will also be disturbed. Future never comes. Well, my final conclusion is, despite your investment, always focus on the present time, not on the future. Because when you are focused on the present, then you are simply into your normal nature, which is there, you found after your birth. Future has not yet come, and past has already been spent or gone. But the present is always there, what we can really enjoy. So if you do investments like that, in any index or mutual funds or any companies, this or that. But remember, you do not have to break your attention from the present and do not focus it on the future to get a big amount of money and then you will start enjoying the life, this and that. All those things are just imaginations. Remember it. You never know the time of your life or the time of the death too. Life is always a suspense. We know our present day, but we don't know even the tomorrow. What to say about 10 years or 20 years? That is definitely just an imagination. So it is important to come out of the imagination and try to live into the reality so that you can really enjoy your normal nature, which is happiness actually. So you can do investments, no problem, and can earn money, but always be focused on the present, not on the future. The United States has one of the most influential and dynamic stock markets globally, attracting millions of share market lovers, from beginners to seasoned investors. These enthusiasts aim to grow their wealth by investing in companies across various sectors. However, with opportunities come risks, and making safe investments requires knowledge, analysis, and right platforms. How to make safe investments in the US stock market? First, diversification. Spread investments across different sectors like technology, healthcare, consumer goods, and asset types. Diversification reduces risk because losses in one sector can be balanced by gains in another. Second, investing in blue chip stocks. Blue chip companies like Apple, Microsoft, and Johnson & Johnson have a history of stability and consistent returns. These companies are typically part of major stock indexes like the S&P 500, ensuring reliable performance over time. Third, using dollar cost averaging (DCA). This strategy involves investing a fixed amount regularly, regardless of market conditions. DCA reduces the impact of market volatility and is suitable for long-term investors. Fourth, analyzing financial statements. Study key metrics such as revenue, profit, margin, and earnings reports. Use platforms like Yahoo Finance, Bloomberg, and CNBC for comprehensive financial data. Fifth, following market trends and news. Stay updated with economic indicators such as GDP growth, unemployment rates, and interest rate changes. Use reliable news sources like MarketWatch, CNBC, and Bloomberg. Analyzing the best share market platforms using US stock market indexes. To find the best platforms for trading, investors often analyze them through the lens of key US stock market indexes. Each index represents a different segment of the economy and provides insights into market performance. First, S&P 500, that is Standard & Poor's 500. What it represents: 500 of the largest publicly traded companies in the US platforms analysis through S&P 500. Look for platforms offering direct S&P 500 index funds or ETFs with low fees. Analyze platform tools for tracking large cap stocks and providing historical performance charts. Second, Dow Jones Industrial Average (DJIA). What it represents: 30 major US companies, often called blue chip stocks. Platform analyze through DJIA. The best platforms offer stock screeners, financial news updates, and performance comparisons for DJIA stocks. Examples include E-Trade and TD Ameritrade, known for their robust analysis tools. Third, Nasdaq Composite. What it represents: more than 3,000 companies, mainly from the technology sector. Platform analysis through Nasdaq. Choose platforms with detailed analytics on tech stocks and real-time Nasdaq tracking. Platforms like Robinhood and Webull are popular for their user-friendly interfaces and real-time market data. Fourth, Russell 2000. What it represents: 2,000 small-cap US companies. Platform analysis through Russell 2000. Small-cap investors should choose platforms offering in-depth fundamental analysis, earnings reports, and growth projections. Interactive Brokers (IBKR) and Think or Swim by TD Ameritrade excel in this area. Fifth, Wilshire 5000 Total Market Index. What it represents: nearly all publicly traded US companies. Platform analysis through Wilshire 5000. Look for platforms providing comprehensive market coverage, sector heat maps, and ETF comparisons. Fidelity and Vanguard offer excellent tools for total market index analysis. Platform features to consider for safe investment. To ensure safe investments, US share market lovers should choose platforms with the following: regulation and security. Platforms regulated by the Securities and Exchange Commission and members of FINRA, Financial Industry Regulatory Authority. Educational resources: webinars, tutorials, and investment simulations for beginner to advanced investors. Analytical tools: advanced charting tools, real-time data, and algorithmic trading features. Low fees: look for zero commission trading for stocks and ETFs. Popular and trusted US stock market platforms. First, Vanguard, best for long-term and retirement investors. Second, Charles Schwab, ideal for research tools and no-fee index funds. Third, TD Ameritrade, Thinkorswim, great for advanced trading tools and technical analysis. Fourth, Robinhood, suitable for beginners with a simple interface and zero commission. Fifth, interactive brokers preferred by professional traders for global market access and low margin rates. Now let's see the conclusion. For share market lovers in America, success lies in a combination of knowledge, strategy, and the right tools. Safe investing involves diversification, understanding market trends, and choosing secure, feature-rich platforms. Analyzing platforms through major US stock market indexes like the S&P 500, Nasdaq, and Dow Jones can help investors align their strategies with the market performance. With careful planning and continuous learning, they can achieve both safety and growth in their investment journey. Here are the main types of trades in the stock market. The first one is intraday trading. Intraday trading is also known as day trading. Involves buying and selling stocks with the same trading day. Participants who engage in intraday trading aim to take advantage of short-term price movements. They typically close all their positions before the market closes, avoiding overnight market risks. Intraday trading requires quick decision-making skills, technical analysis expertise, and a high level of discipline. Traders often use charts, patterns, and indicators to identify potential opportunities for quick profits. The second is scalping. Scalping is a trading strategy that involves buying and selling securities within a short period of time, often just seconds or minutes, with the goal of making a profit from small price movements. Scalpers aim to take advantage of short-term fluctuations in the market and execute a large number of trades to capture small gains. Scalping can be done manually or with the use of automated trading systems and requires a high level of discipline, focus, and technical analysis skills. Because scalpers are exposed to higher commission and slippage costs, they typically aim for a high win rate and small profit targets per trade. The third is swing trading. Swing trading falls between intraday trading and position trading. It involves holding stocks for a few days to a few weeks, taking advantage of short to medium term price fluctuations. Swing traders aim to capture the swings or price movements that occur within an uptrend or downtrend. They use technical analysis to identify entry and exit points based on chart patterns, trend lines, and momentum indicators. Swing trading requires patience, discipline, and risk management skills, as the trader must have the ability to hold positions through short-term volatility without getting shaken out. The fourth is position training. Position trading, this kind of trading is a long-term trading strategy that involves buying and holding securities for an extended period, typically from several months to years. Position traders focus on analysis, the long-term macroeconomic and fundamental trends rather than short-term price fluctuations. They use financial statements, economic data, news, and industry analysis to identify undervalued assets with long-term growth potential. This strategy aims to benefit from the general trend of the market or asset and therefore also requires patience, discipline, and risk management skills. Successfully Successful position trading requires a full understanding of the financial markets, including economic, political, and social factors that can impact the long term outlook for investments. The fifth is momentum trading. Momentum trading is a trading strategy that involves buying or selling securities based on their recent strong performance. Momentum traders believe that financial assets that have performed well in the past are more likely to continue to perform well in the future. The strategy involves buying assets that are rising in price and selling assets that are declining in price, aiming to profit from the continuation of the trend. Momentum traders use technical analysis tools such as moving averages, relative strength index RSI, and stochastic indicators to identify assets with strong upward or downward momentum. With momentum trading, the focus is on the price action rather than the underlying fundamental or economic factors. The sixth one is technical trading. Technical trading or technical analysis involves studying past price and volume data to predict future price movements. Traders using technical analysis use charts, patterns, and indicators to make trading decisions. The seventh is fundamental trading. Fundamental trading relies on analysis of a company's financial health, performance, and economic factors to determine a stock's intrinsic value. Traders using this approach buy or sell based on the underlying fundamentals of the company. The eighth is delivery trading. Delivery trading is a traditional method of buying and selling securities in the financial markets. It involves the physical transfer of ownership of stocks, bonds, or other financial instruments from the seller to the buyer. In delivery trading, the buyer holds onto the purchased securities for a longer period, typically more than one trading day, with the intention of owning them as an investment. Let us go through the conclusion. The stock market offers various types of trading strategies to cater to different investment goals and risk appetites. Each trading style has its advantages and requires a specific skill set, knowledge, and discipline. It is essential to choose a trading strategy that aligns with your investment objectives and risk tolerance. By understanding the different types of trading in the stock market, you can make informed decisions and navigate the market more effectively. Well, finally, we have gone through 8 types of stock trading. What is the Dow Jones business partner Edward Jones, also referred to as the Dow 30? The index is considered to be a gauge of the broader US economy. Key takeaways: the Dow Jones Industrial Average is a widely watched benchmark index in the US for blue chips stocks. The DJIA is a price-weighted index that tracks 30 large publicly owned companies trading on the New York Stock Exchange and the Nasdaq. The index was created by Charles and Dow. The DJIA composition can change over time based on economic trends. The Dow divisor is consistent and that was created to address the simple average issue. Let us understand it. The DJIA is the second oldest US market index after the Dow Jones Transportation Average. The DJIA was designed to serve as a proxy for the health of the broader US economy, often referred to simply as the Dow. It is one of the most watched stock market indexes in the world. While the Dow includes a range of companies, all of them can be described as blue chip companies with consistently stable earnings. In the early 20th century, the performance of industrial companies was typically tied to the overall growth rate in the economy. That cemented the relationship between the Dow's performance and the overall economy. Even today, for many investors, a strong performing Dow equals a strong economy, while a weak performing Dow indicates a slowing economy. As the economy changes over time, so does the composition of the index. A component of the Dow may be dropped when a company becomes less relevant to current trends of the economy, to be replaced by a new name that better reflects the shift. For instance, a company may be removed from the index when its market capitalization drops because of financial distress. So a higher percentage move in a higher priced component will have a greater impact on the final calculated value. At the Dow's inception, Charles Dow calculated the average by adding the prices of the 12 Dow component stocks and diving by 12. The result was a simple average. Over time, there were additions and subtractions to the index that had to be accounted for, such as merger and stock splits. At that point, a simple mean calculation no longer made sense. The Dow divisor and index calculation. The Dow divisor was created to address the simple average issue. The divisor is a predetermined constant that is used to determine the effect of a 1-point move in any of the approximately 30 stocks that comprises the Dow. There have been instances when the divisor needed to be changed so that the value of the Dow stayed consistent. As of February 2024, the Dow divisor was 0.152. The Dow is not calculated using a weighted arithmetic average and does not represent its component company's market cap, unlike the S&P 500. Rather, it reflects the sum of the price of one share of a stock for all the components divided by the divisor. Thus, a 1-point move in any of the component stocks will move the index by an identical number of points. Dow Jones Industrial Average Index Components. The DJIA launched in 1896 with just 12 companies, primarily in the industrial sector. They included railroads, cotton, gas, sugar, tobacco, and oil. The index grew to 30 components by 1928. Since then, it has changed many times. The very first came 3 months after the 30-component index launched. The first large-scale change was in 1932 when 8 stocks in the Dow were replaced. The Dow is re-evaluated regularly. Companies are replaced when they no longer meet the index's listing criteria with those that do. Over time, the index became a bellwether of the US economy, reflecting economic changes. For example, US Steel was removed from the index in 1991 and replaced by building material company Martin Marietta. Other major changes to the DJIA came in 1997 when Westinghouse Electric, Bethlehem Steel, Texaco, and Woolworth were replaced by Travelers Group, Johnson & Johnson, Hewlett-Packard, and Walmart. Walgreen Boots Alliance replaced General Electric in June 2018. In August 2020, Salesforce, Amgen, and Honeywell were added to the Dow, replacing ExxonMobil, Pfizer, and Raytheon Technologies. Raytheon joined the DJIA earlier that year after United Technologies merged with Raytheon Company. Amazon replaced Walgreens in February 2024 after Walmart's stock split, which reduced its weight on the index. So today we got some knowledge about DJIA. Here are some tips to help you win big in high-priced real estate markets. First, research local market trends. Understanding the local market trends is key to making informed investment decisions. Track property values, inventory levels, and average time on the market. This will help you spot trends such as areas poised for growth or when market conditions favor buyers or sellers. Second, leverage market cycles. Even expensive markets experience fluctuations. Buy when the market dips or during slower seasons. Wealthy markets are often influenced by global events, so pay attention to larger economic factors that could create opportunities for a smart purchase. Third, find emerging neighborhoods. Identify up and coming neighborhoods that are still relatively affordable but have potential for rapid appreciation. Look for areas with new infrastructure projects, improving schools, or gentrification. These neighborhoods tend to offer significant upside as they become more desirable. Focus on location. Even in luxury markets, location is paramount. Proximity to major business centers, good schools, public transport, or desirable amenities, parks, beaches, shopping districts will help ensure long-term value and liquidity. 5. Invest in property with multiple revenue streams. In expensive markets, maximizing your return is essential. Consider properties with multiple units, short-term rental potential like Airbnb and or commercial space. These can help you generate income faster and offset high property costs. 6. Work with experienced professionals. In high-end real estate, it is important to work with a team of seasoned professionals. Real estate agents, financial advisors, and attorneys who specialize in luxury markets. They can help you navigate the complexities of high-value transactions and avoid common pitfalls. 7. Get pre-approved for financing. In competitive markets, being pre-approved for a mortgage gives you a significant advantage. Sellers are more likely to accept your offer if they know financing won't be an issue. Additionally, consider working with a mortgage broker familiar with jumbo loans, which are typically in expensive areas. 8. Be willing to negotiate creatively. In high-end real estate, negotiating doesn't always mean lowering the price. You can negotiate favorable terms like seller financing, extended closing dates, or repairs. Creative terms can give you an edge without sacrificing the property's overall value. 9. Consider long-term value. Focus on properties with long-term growth potential. Even if they don't seem like the hottest ticket now, look for areas with future infrastructure projects, rezoning plans, or new developments. Patience can be highly rewarding in luxury markets. 10. Minimize risk with diversification. Don't put all your eggs in one basket, even in the luxury markets. Diversify your real estate portfolio across multiple markets or property types, like residential, commercial, or mixed use. This reduces risk and helps you ride out any downturns in one specific area. 11. Add value to properties. Expensive markets provide an opportunity for substantial gains. If you are able to add value, this can be through renovations, upgrades, or converting the use of the property. 12. Have a contingency plan. Real estate markets, especially expensive ones, can be volatile. Always have a financial cushion for unexpected expenses like repairs or economic downturns, and an exit strategy in case you need to liquidate quickly. 13. Utilize tax benefits. Take full advantage of tax benefits related to real estate investing. This could include deductions for mortgage interests, depreciation, and property taxes, or leveraging 1031 exchanges to defer capital gains taxes when selling a property. 14. Stay patient and persistent. Winning in high-end real estate markets often requires patience and persistence. Prices can be prohibitive, but long-term gains can be substantial if you wait for the right opportunity and avoid getting caught up in short-term market swings. By following these strategies, you can make savvy investments in expensive markets that yield significant returns over time. The Dow Jones Industrial Average groups together the prices of 30 of the most traded stocks on the New York Stock Exchange (NYSE) and the Nasdaq. It is an index that helps investors determine the overall direction of stock prices. How to trade in Dow Jones from India. You can directly buy US stocks from India by opening an overseas trading account with a domestic broker or an overseas trading account with a foreign broker. If you wish to invest indirectly in the US market, you can do so via mutual funds and ETFs and select online investment apps. Dow plunges more than 1,000 points amid fears of US economic slowdown. Stocks in the US plunged for a third consecutive trading day, with the Dow Jones Industrial Average tumbling more than 1,000 points amid growing fears of an economic downturn sparked by a slowdown in hiring and consumer spending. What is the biggest drop in Dow Jones history? 22.61%. The statistic shows the worst days of the Dow Jones Industrial Average Index from 1897 to 2023. The worst day in the history of the index was October 19, 1987, when the index value decreased by 22.61%. What is the highest daily Dow? Dow ends at record high ahead of Labor Day weekend. The Dow rose 228.03 points or 0.6% to close at 41,563.08. The S.I.P 500 climbed 56.44 points or 1% to finish at 5,648.40. The Nasdaq Composite advanced 197.19 points or 1.1% to end at 17,713.62. What are the trading hours of Dow Jones in India? Dow Jones is an index, not a stock exchange. Most US stock markets, including Dow Jones related trading, open at 7 p.m. IST and close at 1:30 a.m. IST. These markets operate from 9:30 a.m. to 4 p.m. in their local time. Trading can sometimes feel unpredictable, and it is easy to get caught up in the ups and downs. That's why having a clear, straightforward strategy can make a big difference. The 3-5-7 rule is one of those strategies. It is not about complex calculations or advanced techniques. It's about making sure you secure profits steadily and reduce risk along the way. I started using the 3-5-7 rule after realizing that I was too often letting good trades slip away. Hoping for a bigger win by applying this rule, I've been able to secure profits more consistently. For example, in one trade, I set my profit targets at 3%, 5%, and 7%. As the stock rose, I took profits at each stage, which allowed me to relax and not worry about a sudden market turn. It is a straightforward approach, but it has made a big difference in how I manage my trades. I want to walk you through how this rule works and how you can start using it in your own trading. What is the 3-5-7 rule? The 3-5-7 rule is a simple approach to managing your trades. Here is how it works. As your trade gains value, you take profits at three different levels: 3%, 5%, and 7%. This method helps you lock in profits gradually. Instead of waiting and hoping for a bigger win that might never come, it is way to be smart about your gains, protecting what you earned as the trade progresses. Why it works? Markets don't always move in predictable patterns. Sometimes a trade that looks promising can reverse quickly, and without a plan, it's easy to get caught off guard. The 3-5-7 rule is about being prepared by setting those 3-5-7 profit targets. You are not just relying on hope, you are taking control of the situation. For instance, if you are in a trade and it reaches a 3% gain, taking a bit of a profit there means you already secured something, no matter what happens next. If the trade continues to rise, great. You take more at 5% and 7%. And if it doesn't, you still walked away with gains. How to implement the 3-5-7 rule? Here is how you can start using this rule. First, plan your exits before you enter. Before making a trade, decide where your 3%, 5%, and 7% profit levels are. This isn't something to figure out on the fly. Having these targets in mind from the start helps you stay disciplined. Second, use tools to stay on track. Set up alerts or use limit orders to automatically take profits at each level. This way, you are not second guessing yourself or getting caught up in the moment. 3. Stick to the plan. It's tempting to hold out for a bigger gain, but remember why you are using the 357 rule. In the first place, it's about securing profits steadily, not gambling on an unpredictable market. The fourth is evaluate and refine. After a few trades, take some time to see how this rule is working for you. Are the percentages right for your style, or do they need a slight tweak? The key is to keep what's working and adjust what's not. The 357 rule isn't about trying to predict the market perfectly, it's about having a plan to manage your trades in a way that makes sense. It helps you take profit when they are available without getting caught up in the emotions of the moment. If you are looking for a strategy that's easy to follow and effective, give the 357 rule a try. It's a small change that could make a big difference in your trading results. Tesla Inc. is an American electric vehicle and clean energy company founded by engineers Martin Eberhard and Mark Tarpenning in 2003, with Elon Musk joining shortly after as a key investor and later becoming its CEO. Tesla is widely known for its innovations in the electric vehicle space, with a mission to accelerate the world's transition to sustainable energy. Over the years, Tesla has become one of the most valuable companies in the world, leading the charge in the EV market, battery storage systems, and solar energy solutions. Let's see its history and founding. Tesla was founded in 2003, named after the famous inventor and electrical engineer Nikola Tesla, who is credited with pioneering alternating current technology. Martin Eberhard and Mark Tarpenning aimed to develop electric cars that would compete with traditional gas-powered vehicles but be far more environmentally friendly. Tesla's early mission was to prove that electric cars could be faster, more efficient, and more exciting than gasoline vehicles. They launched their efforts with the Tesla Roadster, a sports car that demonstrated the potential of EVs. Elon Musk's role. Let's see his role. Elon Musk joined Tesla in 2004 by leading an initial investment round, contributing $6.5 million dollars and becoming the largest shareholder. He, look, he took over as chairman and later as CEO in 2008. Musk's vision for Tesla expanded beyond just building electric cars. He wanted to transform the global energy landscape by making clean energy accessible and affordable. His leadership has often been marked by bold promises, ambitious goals, and controversial moments. But under his guidance, Tesla grew from a niche car maker to a global leader in EVs and renewable energy. Let's see its key milestones. Tesla Roadster. Tesla's first production vehicle was the Tesla Roadster. Released in 2008, it was based on the Lotus Elise chassis but was powered entirely by electricity. The Roadster made waves by achieving a range of 245 miles on a single charge, a major breakthrough for electric vehicles at the same time. It also had impressive acceleration, going from 0 to 60 mph in under 4 seconds, showing that electric cars could be both environmentally friendly and high performance. It's Model S, Model X, and Model 3, Model Y, and also Cybertruck were all satisfactory. Let's see energy products. Tesla is not just an automaker, it's also heavily involved in the renewable energy and battery storage sectors. Tesla Energy produces products like solar panels, the solar roof, and energy storage solutions like the Powerwall, PowerPack, and Megapack. The Powerwall home battery system always allows homeowners to store energy generated by solar panels and use it during outages or at night. Tesla's solar products, particularly the solar roof, integrate solar cells into the roof itself, providing a more aesthetically pleasing alternative to traditional solar panels. In conclusion, Tesla's impact on the automotive and energy industries has been profound, from pioneering electric vehicles to reshaping the way we think about energy storage and productions. Tesla is at the foremost forefront of the transition to a more sustainable future, despite the challenges and controversies that have accompanied its rise. The company remains a symbol of innovation and disruption in industries that are critical to the world's environmental and economic futures. Real estate refers to property consisting of land and anything permanently attached to it, such as buildings, homes, and natural resources like water, minerals, and crops. It is a key sector of the economy and involves the buying, selling, renting, or leasing of properties for residential, commercial, or industrial use. Here are the basics. Types of real estate. First, residential real estate. It includes single family homes, apartments, condominiums, townhouses, and vacation homes. The primary use is for living purposes. Second, commercial real estate. It involves properties used for business activities like office buildings, retail spaces, hotels, and shopping malls. The goal is to generate profit through rental income or business operations. Third, industrial real estate. Properties like warehouses, factories, and distribution centers used for manufacturing, storage, and logistics. Fourth, land. Vacant or undeveloped land, agricultural land, and farms. This can include investment properties bought for future development or raw land. The key terms are real estate agent, broker, professionals who help facilitate transactions between buyers and sellers. Mortgage, a loan used to purchase real estate with the property itself serving as collateral. Appraisal, the process of determining the market value of a property. Equity, the difference between the market value of a property and the outstanding mortgage balance. Lease, a contract where one party agrees to rent property from another for a specific period. Now let's discuss some ways to invest in real estate. First, direct ownership, buying physical property to rent, sell, or develop. Second, real estate investment trusts, companies that own and operate income producing real estate Investors can buy shares much like stocks. 3. Real estate crowdfunding. A group of investors pools money to invest in large-scale real estate projects. Market factors. Real estate markets are influenced by factors such as location, supply and demand, interest rates, economic conditions. Real estate can be a lucrative investment due to potential for appreciation, rental income, and tax benefits, but it also comes with risks like market fluctuations, property maintenance, and vacancy issues. Investing in mutual funds can be a great way to diversify your portfolio and achieve financial goals, but it's important to take certain precautions to manage risks effectively. Here are some key precautions to consider. First, research the fund. Understand the fund's objective, the sectors it invests in, and the track record of the fund manager. Look at past performance, but remember, it doesn't guarantee future results. Second, assess risk tolerance. Choose funds that match your risk tolerance. Equity funds are generally riskier than debt funds, but they also have the potential for higher returns. Third, diversify. Don't put all your money into one fund or one type of fund. Diversification can help spread risk. Fourth, check fees and expenses. Be aware of the fees associated with the mutual fund, including management fees, entry and exit lots, and other charges. High fees can eat into your returns. Fifth, consider investment horizon. Match the mutual fund with your investment horizon. Equity funds are better for long-term goals, while debt funds may be more suitable for short-term needs. Sixth, understand tax implications. Different mutual funds have different tax treatments. Be aware of how dividends and capital gains are taxed. Seventh, review regularly. Regularly review your mutual fund investments to ensure they are aligned with your financial goals and make adjustments as needed. Eighth, stay informed. Keep up with market trends and news that could impact your investments. Stay informed about the economy, interest rates, and other factors that affect mutual fund performance. Ninth, read the offer document carefully. Read the scheme's offer document to understand the details, terms, and conditions. 10th, consult a financial advisor. If you are unsure about which mutual funds to invest in, consider consulting a financial advisor for personalized advice. In today's video, we are diving into a popular investment option, Fidelity Series Growth Company Fund. We'll be breaking down what it is, how it works, and whether it might be the right choice for you. So let's get started. The Fidelity Series Growth Company Fund is a mutual fund that focuses on investing in U.S. growth stocks, companies that are expected to grow at an above-average rate compared to others in the market. The fund is managed by Fidelity Management and Research Company, one of the leading asset management firms in the world. The primary goal of the fund is capital appreciation, meaning it aims to grow the value of your investment over time through its selection of high-growth companies. So, how does this fund pick its stocks? The strategy focuses on companies with strong growth potential, typically in sectors like technology, healthcare, and consumer discretionary. The fund looks for companies that show high earnings growth, solid management teams, and strong market positions. These are the companies that are expected to lead in the future, and the fund aims to capture that growth. Like any investment, the Fidelity Series Growth Company Fund comes with both risks and rewards. On the reward side, you are looking at the potential for significant capital gains, especially if the companies in the fund perform well. However, since the fund focuses on growth stocks, it's also more volatile compared to other types of funds. If the market or the economy takes a downturn, growth stocks can experience significant declines. Another thing to consider is the fees. The Fidelity Series Growth Company Fund has a relatively low expense ratio compared to other actively managed funds. But remember, even small fees can add up over time, so it's important to make sure the potential returns outweigh the cost of management. You can find the exact expense ratio on the fund's fact sheet or on Fidelity's website. Now, who should invest in the Fidelity Series Growth Company Fund? If you are a long-term investor who is comfortable with higher volatility and are looking to invest in high-growth sectors like technology and healthcare, this might be a good fit for you. It's ideal for those with a higher risk tolerance who can ride out the ups and downs of the market. Getting started with a fund is pretty simple. You can open an account directly through Fidelity or through a brokerage platform. Just search for the Fidelity Series Growth Company Fund, review the details, and follow the steps to make your investment. Don't forget to consider your investment goals, time horizon, and risk tolerance before jumping in. To wrap up, the Fidelity Series Growth Company Fund is a solid choice for investors looking for exposure to US growth stocks, especially if you are aiming for capital appreciation over the long term. Just remember to carefully consider the risks, fees, and your own investment strategy. As always, consult with a financial advisor to make sure it fits into your overall portfolio. If you found this video helpful, please give us a thumbs up and let us know in the comments if you are considering investing in this fund. Thanks for watching, and I'll see you in the next video soon. Investing in the Fidelity Select Semiconductors portfolio can be a strong option for those interested in the semiconductor industry. This mutual fund focuses on companies involved in the design, manufacture, and sale of semiconductors and related equipment. As of the latest updates, it manages around $19.83 billion in assets, with the top holdings including Nvidia, Broadcom, and Taiwan Semiconductors Manufacturing Company. Performance-wise, FSELX has shown impressive returns. Over the past year,
it has delivered a return of 76.21%, and its 5-year return stands at 324.62%. However, the fund is more volatile than its peers, with a 5-year standard deviation of 34.11% and a beta of 1.82. The fund is managed by Adam Benjamin, who has been in charge since March 2020. It boasts a relatively low expense ratio of 0.65%, which is lower than the category average. Overall, FSELX offers significant exposure to the semiconductor sector with a solid track record of high returns through it, though it comes with higher volatility. If you are comfortable with these risks and looking for long-term growth, this fund might be a suitable investment. And let's see something now about investing in the Fidelity Select Semiconductors portfolio. First, open a brokerage account. If you don't already have one, you'll need to open a brokerage account. Secondly, research the fund. Review the fund's prospectus and performance details. You can find this information on Fidelity's website or other financial research platforms like Morningstar and Zacks. Third, fund your account. Deposit money into your brokerage account. This can typically be done via bank transfer, check, or wire transfer. Fourth, purchase the fund. Once your account is funded, you can buy shares of FSELX. This is done by searching for the fund's ticker symbol in your brokerage account and placing an order to buy shares. You can choose between a market order or a limit order, a specific price at which to buy. Fifth, monitor your investment. Regularly review your investment to ensure it aligns with your financial goals and risk tolerance. Keep an eye on fund performance, changes in the semiconductor industry, and any updates from Fidelity regarding the fund. For those new to investing, it may also be helpful to consult with a financial advisor to ensure that this fund fits with your overall investment strategy.
Dodge and Cox Stock Fund is a well-regarded mutual fund that has been a strong performer for many years. Here are some key points about investing in this fund. Investment strategy. The Dodge and Cox Stock Fund follows a value-oriented investment strategy. This means it focuses on finding undervalued stocks that have strong long-term growth potential. The fund typically invests in large-cap US companies but may also hold some international stocks. Performance. The fund has demonstrated a solid track record of performance. Over the years, it has consistently delivered competitive returns compared to its benchmarks. For instance, it has shown an average annual return of about 13.9% over the past decade. Management. Dodge and Cox is known for its experienced management team, which employs a rigorous research process to select investments. The team looks for companies with strong fundamentals, solid management, and the potential for long-term growth. Fees. The fund has a relatively low expense ratio of 0.51%, making it an attractive option for cost-conscious investors. Low fees are critical because they can significantly impact overall returns over time. Diversification. DODGX offers diversification across various sectors. Some of its top holdings include major companies in the financial, healthcare, and technology sectors. This diversification helps to mitigate risk and provide more stable returns. Suitability. This fund is suitable for investors with a long-term investment horizon who are looking for exposure to US equities and are comfortable with the volatility that comes with stock market investments. It is particularly appealing to those who prefer a value investing approach. For more details or information, you can refer to resources like Kiplinger and NetWallet, which offer comprehensive analysis and reviews of mutual funds, including Dodge and Cox Stock Fund. Recent updates on the Wilshire Mid-Cap Index indicate a decline in performance. As of December 2024, the index has experienced a decrease with significant movements observed in the broader mid-cap market. For instance, the Wilshire US Mid-Cap Index saw a drop of 1.23% recently, reflecting ongoing market volatility and economic challenges. Wilshire's latest market commentary highlights that despite some recovery in the broader equity markets, mid-cap stocks have faced pressure due to various macroeconomic factors, including interest rate adjustments and global economic conditions. Additionally, the Wilshire Monday Market Flash Report from December 9, 2024 provides detailed insights into these market trends and their implications for investors. For more detailed analysis and regular updates, you can refer to Wilshire's official commentary and performance reports available on their website. Let's see some dealings about it. Dealing with the fluctuations in the Wilshire Midcap Index requires a strategic approach to manage risks and take advantage of opportunities. Here are a few solutions. First, diversification. Asset allocation. Diversify your portfolio across different asset classes. This can help mitigate risks associated with mid-cap stocks by balancing them with more stable investments like bonds or large-cap stocks. Sector diversification. Invest in various sectors within the mid-cap space to avoid overexposure to any single industry. Second, active management, rebalancing. Regularly review and rebalance your portfolio to maintain your desired asset allocation. This ensures that your investments remain aligned with your risk tolerance and financial goals. Active task, doing something very important about it. Employ active management strategies to select stocks that are expected to outperform within the mid-cap universe. This could involve fundamental analysis to identify undervalued stocks with strong growth potential. Third, hedging strategies, options and futures. Use financial derivatives like options and futures to hedge against market downturns. For example, buying put options on the Wilshire Midcap Index can protect against significant losses. Inverse ETFs. Consider using inverse exchange traded funds (ETFs) that increase in value when the underlying index declines. This can provide a hedge against potential losses in mid cap stocks. Fourth, long term perspective. Focus on fundamentals, maintain a long term investment horizon, and focus on the fundamental strengths of the companies within the index. This can help you stay invested through short term market volatility. Growth potential. Mid cap stocks often have a higher growth potential compared to large cap stocks. Investing with a long term perspective can help capture this growth. Fifth, professional advice. Financial advisors seek advice from financial advisors who can provide personalized investment strategies based on your financial situation and goals. Research and insights. Utilize research and insights from reputable financial institutions like Wilshire to make informed investment decisions. By employing these strategies, investors can effectively manage their exposure to the Wilshire Mid Cap Index and enhance their potential for long term returns. The T. Rowe Price Dividend Growth Fund is designed to provide both dividend income and long term capital growth. By investing primarily in stocks of companies with a history of dividend increases. This strategy can help reduce volatility during market turbulence and is often indicative of financial health and growth prospects. Let's see some benefits. Dividend income. The fund focuses on companies that regularly increase their dividends, providing a potential source of income. Second, long term growth. By investing in financially strong companies, the fund aims to achieve capital appreciation over time. Third, volatility reduction. Dividend paying stocks may help to buffer the fund against market volatility. Let's see now the performance. As of recent data, the fund has shown a strong performance. First year return approximately 29.04%. A 5-year annualized return, it's around 12.83%. 10-year annualized return, that is about 12.42%. The fund has outperformed some benchmarks over various periods, though past performance is not indicative of future results. Investment risks. Let's see. Market risk. The fund's value can fluctuate due to changes in the market. Dividend risk. Companies may reduce or eliminate their dividends in adverse economic conditions. Growth investing risk. Growth stocks can be more volatile and may fluctuate more dramatically than other types of stocks. How to invest? Investors can purchase shares of the T. Rowe Price Dividend Growth Fund through various platforms, many of which offer no transaction fee. NTF options such as TT Ameritrade, Schwab, Fidelity. It's advisable to read the prospectus for detailed information on the fund's objectives, risks, and costs. You can visit T. Rowe Price's official website or contact their customer service for more information and to obtain the necessary documents. For more detailed guidelines on investing in the fund and understanding its full range of benefits and risk, consulting with a financial advisor is also recommended. Dodge and Cox Stock Fund is a well-regarded mutual fund that has been a strong performer for many years. Here are some key points about investing in this fund. Investment strategy. The Dodge and Cox Stock Fund follows a value-oriented investment strategy. This means it focuses on finding undervalued stocks that have strong long term growth potential. The fund typically invests in large cap US companies but may also hold some international stocks. Performance. The fund has demonstrated a solid track record of performance. Over the years, it has consistently delivered competitive returns compared to its benchmarks. For instance, it has shown an average annual return of about 13.9% over the past decade. Management. Dodge and Cox is known for its experienced management team, which employs a rigorous research process to select investments. The team looks for companies with strong fundamentals, solid management, and the potential for long term growth. Fees. The fund has a relatively low expense ratio of 0.51%, making it an attractive option for cost conscious investors. Low fees are critical because they can significantly impact overall returns over time. Diversification. DODGX offers diversification across various sectors. Some of its top holdings include major companies in the financial, healthcare, and technology sectors. This diversification helps to mitigate risk and provide more stable returns. Suitability. This fund is suitable for investors with a long term investment horizon who are looking for exposure to US equities and are comfortable with the volatility that comes with stock market investments. It is particularly appealing to those who prefer a value investing approach. For more details information, you can refer to resources like Kiplinger and NetWallet, which offer comprehensive analysis and reviews of mutual funds, including Dodge and Cox Stock Fund. The US presidential election is on the most highly anticipated events globally, not just for its political significance, but also for its massive impact on the financial markets. With the 2024 election drawing near, investors, businesses, and analysts are on edge trying to predict how the outcome will affect the stock market. Historically, presidential elections create volatility in the stock market. Investors react not just to who will become the next leader of the United States, but also to each candidate's policy stance on key issues: taxes, regulation, trade, and government spending. Markets hate uncertainty. In the months leading up to the election, you will often see increased volatility. Investors start positioning themselves based on potential policy changes, which can lead to swings in certain sectors, especially those sensitive to government regulation, like healthcare, energy, and tech. Historically, the market tends to perform better in election years, though much depends on the candidate's policies. A win for a candidate who favors business-friendly policies can cause stocks to surge. Conversely, if there is concern about higher taxes or strict regulations, it may lead to market downturns. In 2024, the candidates have starkly different economic platforms. One might advocate for corporate tax cuts, boosting industries like manufacturing and tech. The other could focus on increased social spending and regulations, affecting sectors like healthcare and energy. If history is any guide, the election outcome could trigger sharp market reactions. A win for one candidate might boost energy and defense stocks, while a victory for the other could favor green technology and healthcare. In general, markets prefer predictability. An incumbent president's re-election usually signals continuity, and markets often respond positively. But when there is a new candidate, especially one with a different agenda, the uncertainty can lead to temporary market disruptions. On election night, markets react in real time. Futures trading often shows wild fluctuations as votes are counted. Investors try to predict the winner, and those predictions send shockwaves through global markets. Leading up to the election, it's all about risk management. You need to be ready for potential dips and spikes, diversifying your portfolio, hedging with safe assets like bonds, and staying informed on key policy positions are crucial. The US presidential election doesn't just impact the domestic market. Global investors closely watch the outcome as US policies on trade, climate change, and military spending can have far-reaching effects on international markets. As we approach the 2024 election, one thing is certain: the outcome will bring change, and with change comes market movements. Investors will need to stay alert, adapt to the new economic policies, and anticipate both opportunities and risks. Stay informed, stay prepared. The 2024 US presidential election will shape the future of the stock market. Thank you. In today's life, it is very important to understand S.I.P or systematic investment planning. Let us see some advantages of S.I.P. First, minimizes risk of lump sum investment. Instead of making a lump sum investment which can expose to investor to market timing risk, S.I.P spreads the investment over time. This reduces the risk of entering the market at a high point and losing value when the market falls. Second, encourages regular saving. Since S.I.P requires consistent investment over a long period, it cultivates the habit of saving regularly, helping individuals meet their long-term financial objectives. Third, takes advantage of market fluctuations. Through rupee cost averaging, S.I.P investors naturally buy more units during market downturns, allowing them to benefit when the market rebounds. Fourth, diversification. Mutual funds offer exposure to a diverse portfolio of stocks or bonds, which reduces the risk compared to investing in individual securities. S.I.P further diversifies the timing of these investments, spreading risk across different market conditions. 5. Tax efficiency. Some SIPs, particularly in equity linked savings schemes (ELSS), offer tax benefits under Section 80C of the Income Tax Act in India. Additionally, long term capital gains from equity investments can be more tax efficient compared to other forms of income. Let's see some potential drawbacks also. First, returns may be lower in the short term since SIPs invest in the market regardless of its current state. Investors may experience lower returns during market downturns in the short term. However, SIPs are designed for long term wealth accumulation, so short term performance is generally less of a concern. Second, discipline required. Although automation helps, investors need to maintain discipline and continue their SIP contributions through market highs and lows. Missing payments or discontinuing during a downturn can disrupt the compounding effect and the potential for long term gains. Third, no guarantees. Like all investments in the stock market, SIPs do not offer guaranteed returns. They are subject to market risks, and investors may experience volatility in their portfolios, especially in the short to medium terms. Conclusion. Systematic investment planning (SIP) is a prudent and accessible investment strategy for individuals looking to build wealth over time without the need for market expertise or large sums of capital. By promoting disciplined investing, leveraging the power of compounding, and mitigating the risks associated with the market volatility, SIPs provide a long term approach to financial planning. While SIPs are not without risks, their flexibility, low entry barriers, and potential for significant returns make them a popular choice among a wide range of investors. Investing in the Fidelity Select Semiconductors portfolio can be a strong option for those interested in the semiconductor industry. This mutual fund focuses on companies involved in the design, manufacture, and sale of semiconductors and related equipment. As of the latest updates, it manages around $19.83 billion in assets, with the top holdings including Nvidia, Broadcom, and Taiwan Semiconductors Manufacturing Company. Performance-wise, FSELX has shown impressive returns. Over the past year, it has delivered a return of 76.21%, and its 5-year return stands at 324.62%. However, the fund is more volatile than its peers, with a 5-year standard deviation of 34.11% and a beta of 1.82. The fund is managed by Adam Benjamin, who has been in charge since March 2020. It boasts a relatively low expense ratio of 0.65%,
which is lower than the category average. Overall, FSELX offers significant exposure to the semiconductor sector with a solid track record of high returns. Through it, though it comes with higher volatility, if you are comfortable with these risks and looking for long-term growth, this fund might be a suitable investment. And let's see something now about investing in the Fidelity Select Semiconductors portfolio. First, open a brokerage account. If you don't already have one, you'll need to open a brokerage account. Secondly, research the fund. Review the fund's prospectus and performance details. You can find this information on Fidelity's website or other financial research platforms like Morningstar and Zacks. Third, fund your account. Deposit money into your brokerage account. This can typically be done via bank transfer, check, or wire transfer. Fourth, purchase the fund. Once your account is funded, you can buy shares of FSELX. This is done by searching for the fund's ticker symbol in your brokerage account and placing an order to buy shares. You can choose between a market order or a limit order, a specific price at which to buy. Fifth, monitor your investment. Regularly review your investment to ensure it aligns with your financial goals and risk tolerance. Keep an eye on fund performance, changes in the semiconductor industry, and any updates from Fidelity regarding the fund. For those new to investing, it may also be helpful to consult with a financial advisor to ensure that this fund fits with your overall investment strategy.
The T. Rowe Price Dividend Growth Fund is designed to provide both dividend income and long-term capital growth by investing primarily in stocks of companies with a history of dividend increases. This strategy can help reduce volatility during market turbulence and is often indicative of financial health and growth prospects. Let's see some benefits. Dividend income. The fund focuses on companies that regularly increase their dividends, providing a potential source of income. Second, long-term growth. By investing in financially strong companies, the fund aims to achieve capital appreciation over time. Third, volatility reduction. Dividend-paying stocks may help to buffer the fund against market volatility. Let's see now the performance. As of recent data, the fund has shown a strong performance. First year return approximately 29.04%. A 5-year annualized return, it's around 12.83%. 10-year annualized return, that is about 12.32%. The fund has outperformed some benchmarks over various periods, though past performance is not indicative of future results. Investment risks. Let's see. Market risk. The fund's value can fluctuate due to changes in the market. Dividend risk. Companies may reduce or eliminate their dividends in adverse economic conditions. Growth investing risk. Growth stocks can be more volatile and may fluctuate more dramatically than other types of stocks. How to invest? Investors can purchase shares of the T. Rowe Price Dividend Growth Fund through various platforms, many of which offer no transaction fee (NTF) options such as TT Ameritrade, Schwab, Fidelity. It's advisable to read the prospectus for detailed information on the fund's objectives, risks, and costs. You can visit T. Rowe Price's official website or contact their customer service for more information and to obtain the necessary documents. For more detailed guidelines on investing in the fund and understanding its full range of benefits and risk, consulting with a financial advisor is also recommended. We are going to go through some of the important key features of the Fidelity Blue Chip Growth Fund. Let's see. The first one is investment strategy. The fund generally invests in large cap growth stocks, which are companies with large market capitalizations and potential for above average growth. The second is portfolio composition. It holds a diversified portfolio of stocks, often including names from sectors like technology, healthcare, consumer, discretionary, and financials. The third is management, managed by experienced portfolio managers who conduct extensive research to select stocks they believe will outperform the market. The fourth is performance objective. The primary goal is to achieve long-term capital appreciation, making it suitable for investors with a long-term investment horizon. The fifth is risk. As with all mutual funds, it carries risks including market risk, sector risk, and the risk of individual stocks underperforming. Investors considering this fund should evaluate their risk tolerance, investment goals, and time horizon, and consult with a financial advisor to ensure it fits within their overall investment strategy. Fidelity Series Growth Company Fund. We'll be breaking down what it is, how it works, and whether it might be the right choice for you. So let's get started. The Fidelity Series Growth Company Fund is a mutual fund that focuses on investing in US growth stocks, companies that are expected to grow at an above average rate compared to others in the market. The fund is managed by Fidelity Management and Research Company, one of the leading asset management firms in the world. The primary goal of the fund is capital appreciation, meaning it aims to grow the value of your investment over time through its selection of high growth companies. So, how does this fund pick its stocks? The strategy focuses on companies with strong growth potential, typically in sectors like technology, healthcare, and consumer discretionary. The fund looks for companies that show high earnings growth, solid management teams, and strong market positions. These are the companies that are expected to lead in the future, and the fund aims to capture that growth. Like any investment, the Fidelity Series Growth Company Fund comes with both risks and rewards. On the reward side, you are looking at the potential for significant capital gains, especially if the companies in the fund perform well. However, since the fund focuses on growth stocks, it's also more volatile compared to other types of funds. If the market or the economy takes a downturn, growth stocks can experience significant declines. Another thing to consider is the fees. The Fidelity Series Growth Company Fund has a relatively low expense ratio compared to other actively managed funds. But remember, even small fees can add up over time, so it's important to make sure the potential returns outweigh the cost of management. You can find the exact expense ratio on the fund's fact sheet or on Fidelity's website. Now, who should invest in the Fidelity Series Growth Company Fund? If you are a long-term investor who is comfortable with higher volatility and are looking to invest in high-growth sectors like technology and healthcare, this might be a good fit for you. It's ideal for those with a higher risk tolerance who can ride out the ups and downs of the market. Getting started with a fund is pretty simple. You can open an account directly through Fidelity or through a brokerage platform. Just search for the Fidelity Series Growth Company Fund, review the details, and follow the steps to make your investment. Don't forget to consider your investment goals, time horizon, and risk tolerance before jumping in. To wrap up, the Fidelity Series Growth Company Fund is a solid choice for investors looking for exposure to US growth stocks, especially if you are aiming for capital appreciation over the long term. Just remember to carefully consider the risks, fees, and your own investment strategy. As always, consult with a financial advisor to make sure it fits into your overall portfolio. If you found this video helpful, please give us a thumbs up and let us know in the comments if you are considering investing in this fund. Thanks for watching, and I'll see you in the next video soon. Female investors in the USA are increasingly making their mark in the financial world. Over the past few decades, the number of women participating in the stock market and other investment avenues has grown significantly. Women are now more financially literate and actively involved in managing their own investments. They tend to focus on long-term financial goals, prioritizing risk management, and often invest in socially responsible or ESG, environmental, social, and governance funds. Additionally, many female investors are leveraging technology and online platforms to make informed investment decisions. This trend is fostering a more inclusive and diverse investment landscape. Here are a few high-profile female businesswomen from the USA who have made significant contributions in the stock market and other business sectors. Abigail Johnson, CEO of Fidelity Investments, one of the largest asset management firms in the world. Second, Mary Barra, CEO of General Motors, notable for her leadership in the automotive industry and innovation in electric vehicles. Ginny Rometty, former CEO of IBM, recognized for transforming the company with a focus on cloud computing and AI. The fourth, Safra Catz, CEO of Oracle Corporation, a key player in enterprise software and cloud solutions. Sheryl Sandberg, COO of Meta Platforms, formerly Facebook, known for her role in scaling the company and her advocacy for women in business. These women have not only excelled in their respective fields but also serve as role models for aspiring female investors and entrepreneurs. Certainly, let's see some of the brief overview of their contributions also and societal impact. Abigail Johnson, contribution. As CEO of Fidelity Investments, Abigail Johnson has significantly expanded the company's assets under management, embracing digital innovation and broadening its offerings. Societal impact. Johnson has championed initiatives aimed at increasing financial literacy and inclusion, providing tools and resources to help individuals make informed investment decisions. Mary Barra, contribution. Mary Barra, as a CEO of General Motors, has steered the company toward a future centered on electric and autonomous vehicles, leading substantial investments in sustainable technologies. Societal impact. Barra's leadership in transitioning to electric vehicles has major implications for reducing carbon emission and promoting environmental sustainability. Mary Barra, as CEO of General Motors, has steered the company toward a future centered on electric and autonomous vehicles, leading substantial investments in sustainable technologies. Societal impact. Barra's leadership in transitioning to electric vehicles has major implications for reducing carbon emissions and promoting environmental sustainability. She also advocates for diversity and inclusion within the workplace. Ginny Rometty, contribution. During her tenure as CEO of IBM, Ginny Rometty transformed the company by prioritizing cloud computing, artificial intelligence, and blockchain technologies. Societal impact. Rometty has been a vocal advocate for lifelong learning and reskilling the workforce to adapt to technological changes. She launched initiatives like P-Tech Pathways in technology early college high schools to create educational opportunities in tech for underserved communities. Safra Catz, Contribution. As CEO of Oracle Corporation, Safra Katz has overseen major acquisitions and the expansion of Oracle Cloud Services, making the company a key player in enterprise technology solutions. Societal impact. Katz has emphasized corporate philanthropy, supporting various educational and humanitarian initiatives. Oracle's technology also supports numerous public sector projects that enhance societal infrastructure. Sheryl Sandberg contribution. Sheryl Sandberg as COO of Meta Platforms, formerly Facebook, played a crucial role in scaling a company's operations and profitability, making it one of the world's largest social media platforms. Societal impact. Sandberg is known for her advocacy for women in leadership through her book Lean In and the Lean In Foundation, which promotes gender equality and empowerment in the workplace. These women have not only driven their companies to new heights, but have also made significant contributions to society by advocating for education, sustainability, diversity, and inclusion. The Wilshire 5000 Total Market Index, often referred to as the Total Stock Market Index, is a comprehensive and inclusive measure of the performance of the entire US equity market, encompassing over 3,500 publicly traded companies. It captures the full spectrum of American corporate growth, from mega cap giants to small cap innovators. As of late 2024, the Wilshire 5000 reflects the dynamic and resilient nature of the US economy, showcasing a remarkable recovery and growth trajectory post-pandemic. The index has benefited from robust consumer spending, technological advancements, and increased business investors. Despite global economic uncertainties, the Wilshire 5000 remains a beacon of strength driven by sectors like technology, healthcare, and renewable energy, which continue to lead market gains. Investors view the Wilshire 5000 as a barometer for economic health, offering a broad perspective on market trends and investment opportunities. With its extensive coverage and diverse portfolio, the index represents the heartbeat of the US stock market, mirroring the country's innovation, adaptability, and economic vigor. Maintaining good entry and exit points in the Wilshire 5000 index or any broad market index requires a strategic approach. Here are some tips to help you maximize your benefits. Entry strategies. Dollar cost averaging (DCA). Invest a fixed amount of money at regular intervals, regardless of market conditions. This strategy reduces the impact of market volatility by averaging out the purchase price over time. Second, fundamental analysis. Assess the overall health of the economy and key sectors within the index. Look for indicators such as GDP growth, employment rates, and corporate earnings to determine the best times to enter the market. Third, technical analysis. Use charts and technical indicators. For example, moving averages, relative strength index RSI, MACD, to identify optimal entry points. Look for patterns and signals that suggest an upward trend. 4. Market sentiment. Pay attention to investor sentiment and market news. Positive news, economic policies, or technological advancements can indicate a good time to enter. Now let's see exit strategies. First, setting targets. Establish clear profit targets and exit the position once those targets are reached. This disciplined approach helps lock in gains and avoid greed. Second, stop loss orders. Implement stop loss orders to protect your investments from significant losses. This ensures you exit a position if the market moves against you beyond a certain threshold. Third, rebalancing. Periodically review and rebalance your portfolio to maintain your desired asset allocation. This might involve selling parts of the index fund when it becomes overweight in your portfolio. Fourth, economic indicators. Monitor economic indicators and market conditions. If signs of a market downturn appear, for example, rising interest rates, declining corporate earnings, consider exiting or reducing your exposure to the index. Fifth, technical analysis for exit. Similar to entry points, use technical analysis to identify when to exit. Look for signals indicating a potential downturn, such as overbought conditions or bearish crossover patterns. General tips: stay informed. Continuously educate yourself about market trends, economic indicators, and global events that can impact the market. Diversification. While focusing on the Wilshire 5000, ensure your overall portfolio is diversified across different asset classes to mitigate risk. Patience and discipline. Stick to your strategy and avoid making impulsive decisions based on short-term market movements. By combining these strategies, you can optimize your entry and exit points in the Wilshire 5000 index, enhancing your potential for long-term gains while managing risks effectively. Thank you. Trading on the surface seems like the perfect gateway to financial freedom. The allure of making quick money from your phone, the stories of traders turning thousands into millions, and the apparent simplicity of the process can be enticing. But behind these glamorous success stories lies a much darker reality. For many, trading can become an obsession, and that obsession can ruin lives. Today, let's explore how trading, when misunderstood or mishandled, can destroy not only finances but mental health, relationships, and overall well-being. The illusion of quick riches at first glance. Trading seems easy. Platforms market themselves as accessible to everyone, and social media is filled with success stories of those who supposedly struck gold overnight. What they don't tell you is that 90% of day traders lose money. The majority who venture into trading are met with disappointment, and as losses pile up, many continue to trade, hoping to recover, falling deeper into the hole. The dream of quick riches transforms into a nightmare of debt and despair. Emotional roller coaster. The stock market is volatile. Watching your investments rise and fall by the minute can send you emotional into overdrive. That constant high and low cycle fuels greed and fear. You start obsessively checking prices, unable to detach from the swings. With every loss, there is a rush to recover. With every gain, there is a fear of losing it all. Over time, this emotional turbulence leads to anxiety, stress, and even depression. The excitement of trading morphs into a psychological battle. Addiction to risk trading, especially in volatile markets like cryptocurrencies, can be as addictive as gambling. The dopamine rush that comes from a successful trade can be exhilarating, but this high can lead to compulsive behaviors. You start to chase losses, doubling down on risky bets, believing that one big trade will fix everything. This addiction to risk can lead to devastating financial consequences, pushing individuals to the brink of financial collapse. Neglect of personal life. As trading takes over, other aspects of life start to slip away. Relationships are neglected. Time once spent with family or friends is consumed by market analysis, chart reading, or monitoring prices. Conversations become dominated by market trends. Slowly, trading becomes all consuming, leaving no room for personal connections, hobbies, or relaxations. This isolation only deepens the emotional toll, and many traders find themselves estranged from loved ones, focused solely on financial recovery. Financial ruin. The most obvious consequence of trading gone wrong is financial ruin. Leverage, margin trading, and risky bets can wipe out accounts in days, if not hours. Savings that took years to accumulate can disappear in a flash. Some traders, desperate to stay in the game, turn to loans, credit cards, or even borrow from friends and family. But in most cases, the market doesn't forgive. The longer one stays in the game, the more likely they are to experience catastrophic losses, pushing them into debt or even bankruptcy. Mental health breakdown. When the financial fallout happens, the mental breakdown soon follows. Trading losses can leave people feeling ashamed, worthless, and trapped. It is not just about the money they've invested, their time, emotions, and self worth into the process. The constant pressure, sleepless nights, and overwhelming regret can lead to severe anxiety, depression, or even suicidal thoughts. What started as a pursuit of financial freedom can ultimately lead to mental and emotional imprisonment. Trading isn't inherently evil when approached with caution, discipline, and solid understanding of risk. It can be a tool for financial growth. But for those who dive in without the proper knowledge, emotional control, or respect for the dangers involved, it can lead to disaster. It's crucial to recognize the risks, set boundaries, and understand that financial freedom isn't achieved through quick, high stakes gambles. Sometimes the price of chasing money can be far greater than we ever imagined. What is Nasdaq? The Nasdaq is the second largest stock exchange in the world. Nasdaq, which is an acronym for National Association of Securities Dealers Automatic Quotation System, was established in 1971. The US-based exchange is also the first ever electronic stock market in the world. Back in the day, stock exchanges were physical trading floors where prices were decided in face-to-face negotiations. Nasdaq changed the way stock exchanges functioned. It had no trading floors and let investors buy and sell stocks on a computerized systems. More than 3,700 companies are listed, including some of the largest technology firms in the world, such as Apple, Microsoft, Google, and Amazon. The exchanges was created by the National Association of Securities Dealers and is overlooked by the US Securities and Exchange Commission. In colloquial language, when people say Nasdaq, what they refer to is the index and not the stock exchange. What they refer to is the Nasdaq Composite Index, which is a statistical measure of a portion of the stock market. Nasdaq also has a Nasdaq 100 index that tracks 100 of the largest and most actively traded equities on the exchange. What is Nasdaq Composite Index? The Nasdaq Composite Index, commonly known as just Nasdaq, is one of the most widely used indices. It tracks the performance of stocks that are traded on the Nasdaq Stock Exchange. It is one of the most popular stock indices tracked by market participants to represent how the market as a whole is performing. To be listed on the exchange, a stock must be listed exclusively on the Nasdaq Stock Exchange and be a common stock of a US-based company or be an ADR, American Depository Receipt, of a foreign firm. Ordinary shares, stocks of a limited partnership interested in tracking equities can also be included in the index. Nasdaq is known to be a tech-heavy index. As of July 2021, technology firms made up half of the index. Nasdaq Composite is a market cap weighted index. This means that each company included in the is weighted based on its total market capitalization. Therefore, companies with bigger market capitalizations have a relatively more significant impact on the performance of the index than firms with smaller MCAPs. What is the difference between Nasdaq and NYSE? NYSE, which is the New York Stock Exchange, is the world's largest stock exchange based on the total market capitalization of its listed stocks. The key distinction is that Nasdaq is a dealer's market with participants trading through a dealer rather than directly with each other. These dealers maintain stock inventories to buy and sell from their accounts in transactions with customers and other dealers. On the other hand, NYSE is an auction market which enables investors to transact with each other via designated market makers. While both institutions are based in New York City, the location of transactions for trading on Nasdaq and on the NYSE are different. NYSE retains a physical trading floor and also conducts trades electronically from New York, New Jersey. On the other hand, Nasdaq does not have a physical trading floor. While Nasdaq is a tech-heavy index, NYSE, which was founded in 1792, is home to many blue-chip firms, including Walmart and Coca-Cola. What is the Dow? The Dow refers to the Dow Jones Industrial Average (DJIA). It is an index just like the Nasdaq Composite, and that indicates the performance of overall stock market. What is the S&P 500 index? The Standard and Poor 500 index, which is referred to as the S&P 500 index, is one of the most popular indices in the world. It comprises the shares of 500 publicly traded companies in America with the highest values of market capitalization. Let's see the key reasons to invest in Ethereum. First, smart contracts and dApps. Ethereum's introduction of smart contracts revolutionized the blockchain space by allowing for automated and secure transactions without intermediaries. This has led to the development of numerous dApps across various sectors, including finance, gaming, and supply chain management. Second, dominance in DeFi and NFTs. Ethereum remains the leading platform for decentralized finance projects and non-fungible tokens. These applications have seen significant growth, contributing to Ethereum's value and utility. Third, network upgrades. Ethereum is undergoing significant upgrades, most notably the transition to Ethereum 2.0 and sustainability by moving from a proof of work to a proof of stake consensus mechanisms. Fourth, strong developer community. Ethereum has one of the largest and most active developer communities in the cryptocurrency space. This community continuously works on improving the platform and developing new applications, ensuring ongoing innovation and growth. Now let's see investment considerations. First, market volatility. Like all cryptocurrencies, Ethereum is subject to significant price volatility. Secondly, regulatory environment. The regulatory landscape for cryptocurrencies is evolving. Future regulations could impact Ethereum's operation and adoption. And third is technological risks. While Ethereum 2.0 promises many improvements, the transition is complex and carries technical risks. Delays or issues during the upgrades process could affect Ethereum's performance and adoption. Potential for growth. Institutional interest. With the approval of Bitcoin ETFs, there is growing anticipation for spot Ether ETFs. If approved, this could derive significant institutional investment into Ethereum, potentially boosting its price and market caps. Investing in Bitcoin and dollars offers two distinct approaches to wealth management. First, Bitcoin, a decentralized digital currency that operates on blockchain technology, is known for high potential returns but also extreme volatility. It appeals to those seeking to diversify their portfolio or hedge against inflation, though it carries risks like regulatory uncertainty and cyber theft. The second, dollars, considered a stable and liquid investment, especially in the form of cash savings or dollar-denominated assets like bonds. It provides lower returns compared to riskier investments but offers stability, particularly during global economic uncertainty. Investing in both can balance growth potential with stability and security, but it requires careful planning and risk management. Binance US is a cryptocurrency exchange platform tailored specifically for users in the United States. It is a subsidiary of Binance, one of the world's largest and most popular cryptocurrency exchanges. Binance US offers a variety of services including trading in digital assets like Bitcoin, Ethereum, and many altcoins. It complies with US regulations, which means it operates under the guidance of agencies like the Securities and Exchange Commission and the Financial Crimes Enforcement Networks. The platform is designed to provide a secure environment for users to trade, buy, sell, and store cryptocurrencies. It offers features such as spot trading, staking, and educational resources to help new users navigate the crypto market. Binance US, however, has fewer features compared to the global Binance platform.